Okay, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Alhamdulillah, Allahumma salli ala Sayyidina Muhammad wa ala alihi wa ashabihi ajma'in amma ba'd. How are you guys? I hope you guys are doing well. So in this video, we are going to learn about managing our portfolio. So before we go further to discuss about how we manage our portfolio, we need to understand about asset allocation. Yeah. And with this asset allocation, we can determine what kind of portfolio strategy that we are going to implement. So before we develop our asset allocation scheme, we need to analyze our characteristic, and we need to state our objectives. We need to also have an overview of portfolio objectives and what kind of policies that we are going to implement. And last but not least, we will develop our asset allocation scheme. All right. So talking about the investor characteristics. Speaking about the investor characteristic, there are several aspects that need to be considered. The first one is the level of income and stability. So we need to analyze how our income and the stability of our income. We need to also to examine the net worth that we have so that we can generate feasible policies to be implemented. Next we have age and family factors. Usually we need to consider our age and our family factors. 10 young investors, they tend to invest in more riskier assets, but old people, old investors, they tend to invest in portfolio with less risk and shorter maturity, with the shorter maturity. Okay, so usually young investors, they are they risk taker, they are risk taker, and they accept risk better than those old people, those old investors. Another aspect that we need to consider is the investment experience that we have and our ability to handle risk, how much risk tolerance that we are able to handle. Last but not least, we also need to consider tax. Usually there are several strategies to be implemented in order to avoid paying high level of tax. And the strategy are implemented to avoid or to defer the payment of tax. There are two main objectives that need to be considered. So the first objective for investing is that we receive a high level of current income. So those who have this kind of objective, they will focus on investing in bond. They will focus on dividends, to receive dividends, to receive coupon payment. That's why they focus on receiving the current income. Another objective to be considered is that many of the portfolio strategy, they focus on capital appreciation. So they buy financial instrument at low price and sell it at higher price. Okay. So these are some explanation of the things that I have mentioned in the previous slide. Yeah, for example, we have the portfolio objectives and policies. There are people who focus on, on receiving income and preserving their capital. So they will focus their investment on low risk, yeah, and conservative investment strategy. And also the portfolio usually contains a low beta, low risk, and they are more into securities with low risk exposure. Yeah, so they will focus on investing in securities with low risk exposure, shorter maturity, yeah, mainly on bond, mainly on, mainly focusing on receiving income from the dividends and from the coupon payment. The next policy, the next portfolio objective and policy is to have a capital growth. Yeah, this can be achieved by a capital appreciations. So they usually apply high risk investment strategy. They focus on investing in securities with longer maturity, securities with higher risk exposure, such as stocks. Yeah, and they usually implement speculative strategy. And if we focus on the capital growth, usually we focus on investing in portfolio with higher beta, yeah, I mean higher risk, yeah, so that they can receive higher capital appreciations. The next objective and policy is to reduce tax. They can reduce tax, yeah, by by putting more emphasis on capital gains and longer holding periods to defer income taxes. So they will focus, to transform their securities into longer term securities, yeah, so that they can defer their tax payment. Last but not least, yeah, we have portfolio objectives and policies which focus on managing risk. So we will try to evaluate, we will try to make some adjustment for our portfolio so that it has a preferable and tolerable risk and return. Yeah. So usually this kind of strategy is implemented by evaluating our portfolio risk and returns in and then after we evaluate, we know the result, we do some adjustment, yeah, to change the weights of the portfolio to to choose, yeah, portfolio with better performance. Okay. All right. Next, we will learn about asset allocations. So it is a process of dividing an investment portfolio into various asset classes, such as US stocks, yeah, such as stocks, bonds, foreign securities, short-term securities, and other tangible assets such as gold and real estate. Yeah. So it is a process. It is an activity where we choose where to invest our capital, whether it is in stock markets, in bond market, in foreign securities market, even to we can also invest in tangible markets such as gold and real estate. Yeah. The studies have found that 90% of portfolio returns come from asset allocations. So if we can diversify our capital, our portfolio into the right asset, to the right securities, yeah, we will gain profit. And 90% of our profit will come from how well we conduct our asset allocation. So if we are doing the asset allocation rightly, yeah, in a correct manner, we can achieve returns and we can make sure that we will receive the expected return. During asset allocation, we do security selection, and it is selecting the specific securities to be held within an asset classes. We will do some analysis and examinations to choose which kind of asset do we invest to. Is it a stock? Is it a bond? It is forex? It is gold? It is real estate? Yeah. So security selection is about selecting specific securities to be held within an asset classes, and this can be done by doing technical and fundamental analysis. And once we have the result from the technical and fundamental analysis, we can choose such specific securities and put them into our portfolio. There are several approaches for doing asset allocations. The easiest one is fixed weighting approach, where we allocate a fixed percentage of portfolio to each asset classes, to each asset class. So for example, we have 100% of our capital and we invest 50% in stock and 50% in bond. So we're putting fixed weights for each asset class, for each asset, for each classification, for each diversification that we do. The second approach is flexible weighting approach. It involves periodic adjustment of the weight for each asset category on the basis of market analysis. So we're gonna do some market analysis. We're gonna do some calculations. We're gonna do some, portfolio analysis, and then we will adjust the weight of our portfolio in each classes. We will put more weight on portfolio which has better performance compared to other classes. So flexible weightings doesn't means that we need to put a fixed and equal weight for each portfolio asset. So we're going to we're going to make adjustment based on our market analysis, and then this adjustment could change the weight, change the weights for every portfolio classes. And then we have the tactical asset allocation. This is a form of market timing that use stock index future and bond future to change a portfolio asset allocations. So we will utilize stock index future, we will utilize bond future and put them into our portfolio. And we do this looking at the market condition after we do some market analysis, and we choose the right timing for investing in those securities. So this table shows an example of how we conduct allocation asset allocation. So we have three alternatives. If we are conservative, we focus on low return or low risk investment. Usually we will put less weights on our investment to common stock. So we will put less weight on common stocks and put more weights of our asset into bond securities, bonds. Because bond, it has near to zero default risk. And it provides with a stable current income with the coupon payment and etc. So conservative strategy, meaning that we put more on bonds and put less weights on common stocks. The second strategy is the moderate strategy, where we focus on average or on getting average returns, and we will tolerate average risk. So in this case, if we compare between the conservative and the moderate, we see that the weight put on the common stocks is increased from 15 to 30%. So we put more stock, so we will buy more stock, we will put more weight on stocks, and we will put less weight on bonds. And if we look at the aggressive strategy where we focus to get the high returns by exposing our portfolio to high risk securities, we will put more weight on stocks and put less weight on bonds. Yeah, so you can see here by moving from conservative to aggressive strategy, we'll put more weights on stocks. Yeah, so the more aggressive we are, we will put the more stock on stock class, yeah, on stock securities, and putting less weights on the bond. So here are the things that we need to consider before asset allocation. These are the things that we need to look at and we need to focus on, yeah, before doing asset allocation. We need to consider the economic outlook of the country. We need to consider also the saving and the spending returns that we have. We need to consider the tax situation and how much expected returns, yeah, from different asset classes. And we need also to know the risk tolerance that we have. Yeah. We will need also to do a periodic reviews, yeah, to maintain consistency with changing investment goals. So there are some investors, they change their strategy for and moving, for example, from aggressive strategy to more conservative, or moving from conservative strategy to be more aggressive. And usually they will conduct periodic reviews, and based on the result, they will make adjustment and they will try to change their investment goals. Yeah, sometimes when the economic are in a good conditions, they are in a bullish market. Yeah, for example, investors tend to be more aggressive, while in economic downturn, while we have an economic recessions, the investors tend to to be more conservatives. They will change their strategy by looking at the market conditions. If we are new investors, we don't have much experience on investing in capital or stock markets. Yeah, we may consider investing in mutual fund, especially when the asset that we use for our investment is under 100,000. Yeah, putting our money to mutual funds actually is a good idea, because our money will be invested by a professional investor managers. So they will conduct their professional analysis, and then they will make actions and make adjustment based on their professional review. And they have better resources, they have better knowledge, and it is more favorable for those new investors and those new investors with less experience. Yeah, they can put their money in mutual fund and let the professional do the investing, the investment. They will be guided, yeah, by the professional investment manager that has higher resources, high knowledge, yeah, better experience, and etc. We need also to design how our asset allocation plan for long term. For example, from 7 to 10 years. Usually, we have goals. Yeah, people in those investors, they have goals to be achieved and they will divide it into short, middle, and long-term goal, and we will try to adjust our portfolio strategy with the goals that we have. For example, for the short-term strategy, maybe we put in those securities that generate a high profit, and then moving to longer period, we will change our strategy to be moving towards more conservatives, for example. Yeah. Another thing that we need to consider is the key to success is remaining faithful to your asset allocation and fighting the temptation to deviate from your plan. Yeah, sometimes we change our plan. Sometimes we change our objective. For example, at the beginning, we will focus on on investing in high risk securities, but when we are getting older, yeah, once we are, for example, retired and become retiree, yeah, we will focus on investing in short-term security with a lower risk exposure that provides stable income. Yeah, so these change. Yeah, so our objectives, our portfolio strategies may change, and this change can happen due to our life circumstances. So we need to be faithful. We need to keep going on what we believe, what we have already planned, and stick to the plan until we achieve our goals. And once we achieve our goals, we may try different goals, or we may adjust our goal to fit into our current conditions. All right, so so now we will learn about how we evaluate the performance of individual investment. Yeah. So it is important for us to analyze periodically and to evaluate the progress of our investment portfolio. And we can do this by obtaining data, and then we can compare, yeah, the performance of our portfolio with some indexes, yeah, and then we measure, yeah, the performance of our investment by having the calculation of expected return and etc. And then we compare our performance to investment goals. Yeah. So the thing that we need to highlight here is that in this slide, yeah, they want us to do a periodic assessment, to always evaluate of our investment, and do adjustment when such adjustment are needed. Okay, so we can, first of all, we need to obtain the data, and this data could be obtained from Wall Street Journal, from Yahoo Finance, yeah. And there are two key areas to stay informed about, which is the return data. Yeah, so this return data, yeah, is a very important. It's an indicator of the performance, and we need also to know the economic and market activity. So once we have the updated informations about the economic, we need to make a correct adjustment for every market conditions. Yeah, we can also measure our portfolio and compare it with famous indexes. Yeah, for example, Dow Jones Industrial indexes. We can also measure and compare our portfolio with S&P 500, the Nasdaq Composite Index, yeah, Dow Jones Corporate Bond Index, and etc. So there are a lot of indexes, yeah, to be a guide to use for a comparison, and hopefully this comparison will provide us with informations whether we are doing good or not with our portfolio. And if we are doing bad, yeah, if we're not doing well in our portfolio, then we have to make a correct adjustment, yeah, based on our calculation and measurement. The first measure of our performance could be calculated by by calculating holding period return. Yeah. So this is one indicator to show how our performance is. Yeah. So it is an excellent way to assess investment performance because it focuses on the total returns, not just the price change or the income. So how do we do this? We will add the current income during the period plus the capital gain or the loss during that period divided by the beginning investment value. So the holding period returns will give us an indicator how well we do our portfolio investment and how well we manage our portfolio investment. The capital gain or loss during the period can be calculated by subtracting ending investment value minus beginning investment value. Yeah. So for example, we can or before we move to the example, for example, so here are the explanation, for the holding period return. For stock and bond, the holding period return for common and preferred stock include both cash dividend and any price change during the holding period. So it is included, so the dividends that we receive from the stock and any price change during the holding period are included in the calculation of holding period return. And then the holding period return for a bond investment includes two components, which is the interest income that comes from the coupon, the coupon payment, and the capital gain or loss after we sell our bond. So both of the stock and bond, they focus on the dividends, the returns that we receive, and the price change, the capital gain or the capital loss. For mutual fund, components of return from a mutual fund investment are dividend income, including the capital gain distribution and change in value. So the mutual fund consists also the dividends that we receive and the change in value. For option and future product, the only source of return on options and future is the capital gains, as we know that option and future pay no dividend and it also pays no coupon payment. So the main focus, the main component of returns is the capital gain. So this is an example of one portfolio, on common stock. We see that, for example, they invest this portfolio. So they invest on U.S. Steel common stock. Date of purchase June 1st, 2017, and the purchase cost is $20,500. Date of sale June 4, after 3 days. After 1 year actually. After 1 year, and then the sales. So they buy at $20,500 and they sell at $37,270, and they receive dividends of $200. So the holding period return is that 200, the dividend received plus, so this is the sale price minus the purchase price, the buy price, the purchase price divided by the initial cost, the purchase price, and then we have a holding return period, a holding period return of 82.78%. If it's positive in value, means that we are making profit, our portfolio is doing well. But if it's in negative, if it's negative in value, that means that our portfolio is experiencing losses. So we need to adjust our portfolio, and we need to make our calculations, in order to make right adjustment. Another example, this is bond, the bond which pay 10% of coupon. So we purchase, 1st June 2017, and the price of the purchase is 10,000, and we sell it at 9,704, and we receive a coupon payment of 1,000. Yeah, so the holding period is 1,000 plus 9,704 minus 10,000 divided by 10,000, and we will receive a holding period return of 7.04%. And of course, the holding period return for bond is less than the holding period return of stocks. This is the example if we invest in mutual fund. So, for example, we buy Pebble Fall Mutual Fund, July 1st, 2018, and the purchase cost is $10,400 US, and we sell it at and we sell it on 3rd July 2019 after 1 year. Yeah, and the selling price is 10,790 US dollar. And during this holding period, we receive dividend, investment income dividend 270, and we receive also the capital gains dividends to 320. So we add these dividends, and then we subtract the selling price minus the buying price divided by the initial investment that we make. So we have a positive return of 9.42%. So we are getting a profit of 9.42% from this investment in mutual fund. So we can compare the performance to our investment goals. So, and then we can balance our risk and return. Are you getting the proper return for the amount of investment risk you are taking? Do we get an expected return? Do we get a proper return for the amount of investment risk that we are taking? So isolating problem investment. We analyze each investment periodically and consider has it performed in a manner that could reasonably be expected. So are we getting a profit that we are expected in the beginning, or in our plan? If the performance is not as expected, we may do some adjustment. A problem investment is one that has not lived up to expectations. For example, we are expecting that this stock, these bonds, this mutual fund will generate a profit in the future, but in reality, we fail to get the profit, and we receive losses from this investment. And should you take your loss and get out, or should you hang on and hope it turns around? So this is telling you that if you see that your investment is not doing as expected, are you going to sell it, or are you going to hold it for a little bit longer until it turns around, and maybe they will increase in price and value and etc. So this decision need to be made, and it should be carefully carefully calculated, and we need to use every available data, every available information to make decisions. Okay, next we are still in assessing our portfolio performance. So a portfolio can be passively or actively managed. So passively means that we are not actively trade our portfolio, so we tend to wait, and let's the price goes up. So we are passively means that we are not trading in an active manner. Yeah, so we tend to wait to buy and wait until the price increases, and we tend to take longer position. Yeah, longer position. I mean, we hold it for a longer period until the price increase. So the passive portfolio result from buying and holding a well-diversified portfolio. Active portfolio management can help you adjust your portfolio as your investment objective change. So if we are passive, mean that we tend to buy and wait until it has a capital appreciation, even though that you have to wait for a long period. But if we are actively manage our portfolio, means that we will make adjustment which are often, yeah. So we often make adjustment, yeah, and we'll try to evaluate the market. We try to make some market analysis and do the adjustment, yeah. And we can do also a comparison between our return and the overall market measures. For example, we use the index and try to compare our portfolio performance with the index, and we can make a portfolio revision. So portfolio revisions mean that portfolio adjustment. We let go those portfolio, those assets, those investments that are not doing well, and buy new asset, buy new stocks and bonds which may or which are expected to perform well in the future. So this is a portfolio adjustment or portfolio revisions. Yeah. So these are measuring portfolio performance. Yeah. So so measuring an amount invested, we need the list holding, number of share, acquisition debt, cost, the current value, and we measure also our income, the dividend for both received from bonds and interest, and also we measure the capital gains, whether it is unrealized or realized capital gains. This is an example of the data need to calculate our portfolio expected return. Yeah. This is the list of company, the number of share, the date acquired. This is the date that we buy. Yeah. And the total cost, including commissions, the cost that we pay for buying this number of shares for this company. And then the cost per share, the current price per share, and the current value. So you see here we have the current value, and we see here we have the total cost including commissions. And you see that it has increases from 21,000. So we pay 21,610 US dollar, and the current value is 30,000 US dollar. You see that it has an increase in capital. Yeah. So the price of this stock, it has increased. Next, we also measure the annual dividend, the dividend received. Yeah. So this is the dividend received for every stock, and then we have the number of stock, we multiply, and then we receive the dividends. So these are the dividend received from this investment portfolio. Yeah. And then we have unrealized gains in value of Hathway portfolio. So unrealized mean that it is not sell yet, so you're still holding it. Yeah. So this is the unrealized gains or the unrealized loss. We have the last market value, for example, today. Yeah, today, January 1st, 20. And this is the this. Oh, I see. So this is the market value in the 1st January of this year. Yeah. And this is the market value of the last 31st, yeah, 31st December of this year. So this is the the beginning period. Yeah, this is the end period. Yeah. So this is the unrealized gain or loss, and it is the percentage. So we get this percentage by having the market value, the end market value minus the beginning market value divided by the beginning market value. So here we have minus 10% of loss. So if we take the average of this percentage change, we will have uh, the the average return of the portfolio of 8.9%. So this is the average return for such portfolio. Yeah. So this is the portfolio made up from stocks, and this is the company that they invest in, yeah, with the number of shares. Okay. So measuring portfolio return, yeah. So we take the dividend and interest received plus realized gain plus unrealized gain and divided by the initial equity investment plus new fund and number of months in portfolio minus withdrawn fund multiplied by number of fund withdrawn from portfolio divided by 12. And this is the holding period return, yeah, of a portfolio. Yeah, see this. This formula can be used in order to calculate the holding period return for portfolio. In the previous slide, we are calculating the holding period return for each stock or each bond or each asset class. But at the next slides, at this slide, we calculate a holding period return for a portfolio. All right, so this slide is a simulation of how we calculate our holding period return for portfolio. Yeah, for example, yeah, this is the portfolio value in the 1st of January 2020, and this is the portfolio value in the 31st of December in the same year. So this is the beginning value, and 356,000 is the end value. Yeah, so we have a realized appreciations. Yeah, so realized means that the stocks that are sold. Yeah. So this is the returns that we receive after a realizations, mean that after we sell the securities. Yeah. And we have the unrealized appreciation, and this is the asset that we are still holding. Yeah. And we have also dividend received, yeah, 10,965. And last but least, we have a new invested or withdrawn, which is none. So first, we will add the dividends plus the realized appreciation and unrealized appreciation divided by the first portfolio value, yeah. Plus, if we have a new fund or withdrawn fund, then we need to, to consider. But in this case, we don't have new fund investors or withdrawn, so that's why we put 0, 0 here. So the portfolio return, so the portfolio holding period return is 13.25%, meaning that we are having a profit. Next, we have also a measure of risk, yeah, which is the Sharpe measure. So we can use these indicators to compare, yeah, the risk of our portfolio. So the higher this Sharpe measure, the more risky our portfolio would be. So the Sharpe measure can be calculated by total portfolio return minus the risk-free rate divided by the standard deviation of a portfolio return. Yeah, so we have the portfolio return minus the risk-free rate. So the risk-free rate could be the rate that we receive from the deposit or the rate that we receive from bond, investing in bond, coupon payment, for example, and divided by the standard deviation of that portfolio return. The higher this measure, the better. Yeah. So I correct, yeah, what I have said just now. So this Sharpe measure compare the risk premium on the portfolio with the portfolio of standard deviation of the return. So the higher the value of Sharpe measure, meaning that we are having a portfolio with less risk, and the lower the Sharpe measure, meaning that our portfolio is uh, ex is exposed to higher risk. Okay. Uh, so this is the same, yeah, the same calculation, uh, holding period return. And now we have the tenor measure. So it we use the portfolio beta to measure the portfolio risk. So this is another measure of risk, yeah. So we get the tenor measure by subtracting total portfolio return from risk-free rate divided by portfolio beta. So remember the beta is is a measure of how much risk, yeah, that we have, yeah. So in general, the higher the value of tenor measure, the better. So meaning that if we have a high tenor measure, meaning that our portfolio is exposed to less risk, but lower tenor measure means that our portfolio is exposed to higher risk. Another indicators that we can use is Janssen measure, or we can call it Janssen alpha. So we use the capital asset pricing model, CAPAM, to calculate portfolio excess return, yeah, amount by which portfolio actual return deviates from is required or expected. All right, so I'm sorry, yeah, let me continue. So there's another indicator that we can use in order to 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 know, yeah, the performance, to evaluate the performance of the portfolio. This indicators called Janssen measure or Janssen alpha, and it uses the capital asset pricing model, the CAPA, to calculate portfolio excess return. And positive value indicates superior performance, while the negative value indicates the portfolio has failed to earn its required returns. So, this Janssen's alpha tends to be preferred over Sharpe and tenor measure. So we calculate this by having, yeah, a subtraction of total portfolio return minus risk-free rate minus, yeah, the portfolio beta and multiplied by the market return minus the risk-free rate. So once we have a positive value, means that our portfolio has a superior performance, and negative value means that our portfolio has failed to earn its required return. Next, we do a portfolio revision. So it is a process of selling certain issues in a portfolio and purchasing new ones to replace them. So usually those stock which has a bad portfolio performance, we gotta sell them and replace them with new ones, new portfolio that are expected to have a great performance in the future. Yeah. So it says that a periodic reallocation and rebalancing are necessary. So usually investor nearing retirements wants to change strategy, and also the change in risk return characteristic of individuals, and also to maintain their diversifications. So portfolio revision is important, and it is used by investors, yeah, for different reasons. For example, changing the portfolio characteristic, yeah, portfolio objectives, and etc. All right, so next we will discuss about timing transactions. Yeah, so timing transactions is actually a method or an approach to tell you when to buy. And we have several approaches that we can use to uh, to inform you about the time that we should buy or sell our investment. So the first approach for timing transaction is actually the formula plans. It is a mechanical methods of portfolio management which try to take advantage of price change that result from cyclical price movement. Yeah. So usually we have a cyclical price movement. For example, uh, during Ramadan, yeah, the stock price are usually low in price. They are tend to be cheaper in the beginning of Ramadan, but at the end of Ramadan, the stock price are usually higher in value. So there is kind of uh, a cyclical trend that we can observe for the performance of such investment. And we can evaluate, we can notice this trend and try to make a favorable strategy to uh, to 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 have a right investment. Yeah, so if we can note, yeah, some of the cyclical change in the price of the stock, we can make a favorable strategy and we can make the right adjustment where to buy and to sell. Yeah. There are actually four uh, popular formula plans. Yeah, dollar cost averaging, constant dollar plan, constant ratio plan, and a variable ratio plan. So first we gotta discuss about the dollar cost averaging. It is a formula plan in which a fixed dollar amount is invested in a security at a fixed time intervals. Yeah, so it is a fixed dollar amount invested in a security at fixed time intervals. So for example, I will put $10 for uh, every in the first day of the month. Yeah. So I will invest $10 in every first date of the month. In the first date of the month. So $10, $10, $10, $10 in every first date of the month. Yeah, this is called dollar cost averaging. Yeah. It has characteristics such as a passive buy and strategy. Yeah, so the periodic dollar investment is how constant to make the plan work. You must invest in a regular basis. The goal is growth. So the goal of doing this dollar cost averaging is to achieve growth. Yeah, in the value of the security to which the funds are allocated. Purchases more share when prices are low and fewer share when prices are high. So this is an example of dollar cost averaging. Yeah, so here we have, for example, the number of share purchase. Yeah. Um, so so in this portfolio, yeah, the investment manager will invest $500 per month. Yeah. So and this is the number of shares that they get. And as you can see here in the net asset value, see that the net asset value uh, has its price each month, has its value each month, and this is the number of share purchase. So by doing fixed dollar cost averaging, meaning that we contribute, yeah, we put a fixed amount of dollar for a fixed period, yeah, fixed inter uh, fixed interval. Okay. This is the annual summary for the dollar cost averaging. Yeah. So this is the total investment at the beginning period, and they continually, yeah, invest $500 per month, and this is the number of share purchase, and this is the average cost per share, and then the value of the portfolio at the year end. See that we have an increase of 881 US dollar increase in value for this investment. Yeah. Next, we have a constant dollar plan. So it consists of a portfolio that has two parts. So we have a speculative part and the conservative parts. So meaning that we divided our portfolio into two parts, the conservative and the speculative. The speculative portions consist of securities that have high promise in capital gain, such as stocks, while the conservative portions consist of low-risk investments, such as bonds or a money market account. So the target dollar amount for the speculative portion is constant. Yeah, when speculative portion increase to a predetermined dollar amount, profits are transferred to conservative portions. And if speculative portion decreases, funds are added from the conservative portion. So this is the strategy. Yeah, this is a investing style. When you have two different parts of your portfolio, you have the speculative and you have the conservative. And once you receive high income from the speculative portions, you will add the investment in the conservative portions. And once you have a loss, yeah, in the speculative portion, you will add, yeah, you will add the speculative portion from the conservative portion. Yeah, yeah, it's a kind of strategy, very good to use, and I believe that it will make a good strategy, especially if we concern about capital gains. Yeah, this is the example. So we have two parts here. We have the speculative portions and we have the value conservative portion. And we see that yeah, we see that here the value of conservative portions. Yeah, we see the value of speculative portions, and this is the total value. The total value, and here they sold, yeah, the shares and put these shares to add in in the conservative portions. Yeah, something like this. Okay, now we have another formula plans, which is constant ratio plan, similar to the constant dollar plan. Only the ratio between speculative and conservative portion is fixed, while we have the variable ratio plan, similar to constant ratio plan. Only the ratio between speculative and conservative portion is allowed to fluctuate to predetermined levels. So most aggressive of the four formula plans, it attempts to turn stock market movement to the advantage by timing the market. So buy low and sell high. So we have another formula plan, we have constant ratio plan and a variable ratio plan. Yeah. So let's see that this is an example of constant ratio plan. So we put, yeah, a fixed amount, yeah, similar with respect to conservative portion is fixed. So we have a fixed portion, yeah, fixed amount of portion. For example, here, yeah, they have a fixed Yeah. So they tend to preserve, yeah, they tend to preserve the portion, yeah, the value of each portions. And this is a variable ratio plan. You can see that the value of speculative portion and the value of conservative portion are changing by time, and they will adjust to the market conditions, and they see if there is a market condition that are favorable for them, they will try to make a correct adjustment, yeah, to follow the market. You can see that the value, yeah, the ratio between speculative portion to the total portfolio value are changing, yeah. But here they actually keep, yeah, the value, the ratio of speculative portion to conservative portion is almost the same. It's almost the same, it's almost fixed. While here, the ratio of speculative portion to the total value is always changing, and they change it based on the market conditions. Next, we have actually the features we uh, where we put orders. So we have the limit orders and the stop loss orders. So limit orders may be used to purchase in the additional securities only at desired purchase price or below. So you're gonna put the limit price, and for example, you're going to buy such stock at predetermined price. So once the stock hits this limit price, it will automatically buy. And you can do also in selling. So you put the limits sell price, and once it pouch down the limit price, yeah, the limit sell price, yeah, it will automatically sell the stock. This is what we call limit orders. Uh, we can also use a stop loss orders. So stop loss order means that we use to limit the downside loss exposure to protect the profit of an investment by selling it when price fall below a predetermined price. So limit orders is used only to buy, while the stop loss order are used for selling. So we will tell the system to set a limit price of selling. So once it touch this limit selling price, the system will sell our stock automatically. But for the limit orders, once it touch this limit price, yeah, the system will automatically buy our stock, and it will implement our orders. So limit order is used to purchase, but stop loss order is used to sell, especially if we want to protect our portfolio for, you know, for a loss. Yeah, so we will stop holding, yeah, at a certain price limit. So once the price touch that limit, it will automatically sell, so that we're not going to have a big loss. There is also a risk of whipsawing. It is a situation where a stock temporarily drops in price and then bounce back upwards. So there is a risk of whipsawing when we put a stop loss orders. Usually we put a limit price, right? For example, we put at 3.5. So when the stock price reach 3.5, it will automatically sell. Yeah, but in reality, we cannot predict the market. Maybe it will touch $3.5, but it will bounce back. So the system cannot predict this bounce back, and that's why we have a risk of whipsawing. So when we put the price, the limit price sell, yeah, usually we need to bear this risk of whipsawing, so that when it touch this selling price, yeah, it will automatically sell the stock, and and we cannot now, yeah, and maybe the stock will bounce back and it will return to the normal performance. So this is the risk that we need to consider. We have also a warehouse liquidity. So what does it mean, warehouse liquidity? It is a recommendation for an efficient portfolio to keep a portion of it in low risk, highly liquid investment. Yeah. So for example, we have a 100% of stock. So we use 5% of this 100 weights of stock to invest it in a low risk and high liquid investment. Yeah. This is in order to protect against total loss and for the possibility of future opportunities. So in case if we have future opportunities, for example, we see that some prices are low in price, we can sell this warehouse stock and turn it into liquidity and buy this new stock. Yeah. So this is a use to prepare for the opportunity to buy and also to protect us from total loss. So we use money market deposit account at financial institutions and money market mutual funds. So we use the deposit that we put in the bank, and we will wait. So in case that we see an opportunity for such investment, we can use this opportunity by liquidating our warehouse stocks or warehouse asset. Yeah, and we can use this to optimize the future opportunities or to protect against total loss. All right, last but not least, we have timing for investment sales. There is a tax consequences that we have to consider. Yeah, tax affect nearly all investment decisions. So treatment of capital losses is important. A maximum of 3,000 of losses in excess of capital gain can be written off against other income in any 1 year. So we can use capital losses to offset the capital gain. Yeah. So, and also another considered aspect is achieving investment goal. So when investment become more or less risky than desired, or it has not, or if it has not met its return objective, it should be sold. So once you consider that you are not achieving your goal, it is far from the planned objective, you may sell the stock or you may sell the portfolio. Don't hold out for top price. Take your profit and reinvest them in appropriate assets. So sometimes there are people, they want to hold, yeah, their asset a bit longer. They want to reach the top price, but in reality, they never achieve the top price, and they are starting to lose the money because they don't sell at the right time. So this might destroy your investment portfolio, and you may end up with a lot of losses. Yeah, I think that's for the managing portfolio. I hope that you can learn basic idea about how we manage portfolio, how we calculate the portfolio returns, and know how, when to buy and how to implement strategies for managing the portfolio. Hope this video will give you some basic informations about the portfolio management, and hope this video can give you an idea about how we can implement, we can make timing, we can do asset allocation, and so on. Thank you, and hope you guys are doing well. I close this video. Assalamualaikum warahmatullahi wabarakatuh.